Good afternoon, everyone. I am Shajujjo Gangopadhyay from the Department of Mathematics, St. Xavier's College, Kolkata. I would like to thank everyone present here today for taking out time from your busy schedules to join us. In the last 2 years, our world as we knew it has changed drastically. As the entire world recovers from the blow of the coronavirus, we look towards a bigger and brighter future for all of us gathered here. It's said that the night is always darkest just before the dawn. With that in mind, the Department of Mathematics at St. Xavier's College, Kolkata continues on its relentless path to impart knowledge and change lives. In these times of despair, we have all looked towards the light of knowledge to guide us. As part of this endeavor, St. Xavier's College has been an active participant in spreading knowledge and ensuring growth academically, personally, and professionally for all its students and faculties throughout these tough and testing times. As a tribute to this recognition, I feel proud to say that our college has been ranked 4th by the National Institute of Ranking Framework, Government of India. We have gathered here today for a national webinar presented by the Department of Mathematics. Our webinar today would focus on finance profiting from randomness. To illuminate us on this very interesting topic today, we have as our speaker Professor Habib from the Department of Mathematics, Shiv Nadar University. Modern finance has an intimate relationship with diverse areas of mathematics. In today's webinar, we will first take up some of the most famous developments during the last century, such as the Markowitz mean variance analysis for portfolio design and the capital asset pricing model. We will continue with problems thrown up by the recent financial crisis, which indicate that these classical models are too optimistic about risk. And finally, we will discuss the ongoing efforts to improve or replace them. As we traverse through our webinar, I'd like to tell you some housekeeping rules in general. Everyone present with us over Zoom is requested to keep their video and audio off during the entire duration of the webinar. I request everyone on Zoom to ask questions only through the Zoom chat box. Everyone on YouTube is requested to ask their questions through the YouTube chat box only. We would be answering the questions only at the end of the webinar, subject to time availability. I would once again like to thank everyone for being here today. With this, I would heartily like to welcome our principal, Reverend Father Dr. Dominic Savio SJ. Father has been a source of tremendous inspiration for all its students and faculties. It gives me immense pleasure to say that Father Principal has been awarded the Shiksha Ratna Award 2021 by the Department of Higher Education, Government of West Bengal. With this, I would like to call Father to grace us with his presence, deliver the inaugural address, and initiate our program. Over to you, Father.
Thank you. Thank you very much. Very good afternoon to all of you. I would like to welcome all of you to the national webinar, which is organized by the Department of Mathematics on the topic finance profiting from randomness. I would extend a very warm welcome to the speaker of this webinar, Professor Habib, Professor, Department of Mathematics, Shiv Nadar University. It is a privilege to know someone so well versed in the topic. We honestly appreciate your presence today, Professor, and the students and the faculty are eager to hear you speak. As we all know, modern finance has much to do with the mathematics. It's all about automating time-consuming, repetitive, financial and accounting operations and implementing best practices to increase efficiency. Financial risk is a significant study. If investors have all the knowledge they need, they will make reasonable investment decisions. One assumption is that investors are looking for a low risk, high reward situation. Depending on their risk aversion qualities, various investors will evaluate the trade-off differently. The implication is that a sensible investor will not invest in a portfolio if a second portfolio with a more favorable risk anticipated return profile exists. That is, if a portfolio with a superior expected returns exists for that level of risk. I would like to congratulate and extend my heartfelt gratitude to those who have worked hard with a lot of effort on this day's event. And especially I would like to thank Professor Sucharita Roy, the head of the Department of Mathematics, and all the professors and all the students who have taken a lot of effort to have this seminar with the very eminent president, Professor Habib. St. Xavier's College Mathematics Department has been holding webinars for its students on a variety of topics. The department professors and students are brimming with enthusiasm about recognizing the wonders of mathematics and participating in events that pique their interest in the subject. I wish this webinar great success and would like to welcome once again Professor Habib. I'm sure you will be having a wonderful afternoon with Professor Habib. Wish you all the best. May God bless you. Thank you very much.
Thank you, Father. I would now like to call Professor Deeptiman Shaha from the Department of Mathematics, St. Xavier's College, Kolkata, to introduce Professor Habib. Over to you, Professor.
Thank you, Shajidjo. Good afternoon, everybody. It is my privilege to introduce Professor Habib. He is one of those few mathematicians in India who breaks all barrier between pure and so-called pure and applied mathematics. He has done integrated MS in mathematics from IIT Kanpur, then PhD from University of California, Berkeley, and held postdoctoral position at the Harish Chandra Research Institute, Allahabad, and Bangalore Center of Indian Statistical Institute. Then he joined St. Stephen College, Delhi, and from there he moved to Mathematical Sciences Foundation in Delhi. Then again, he joined Shiv Nadar University and serving there till date. He is now head of the department in Shiv Nadar University, Department of Mathematics, since 2013, and also Dean of Undergraduate Studies since September 2015 in the university. If I talk about his research interest, it is immense. His main research interests are in representation theory and mathematical finance. He is comfortable in giving lectures from undergraduate level to research level, from hardcore mathematics like Lie group, number theory, to financial mathematics. He taught practically all the topics in mathematics, from complex analysis to differential geometry, from probability to mathematical finance, from Lie group to topology. He breaks all barrier of mathematics. He published also several papers in reputed journal and 3 books perhaps. And this is not the end. For about last 20 years, he has been involved in effort to make mathematics at the school and college level more interesting and fulfilling through their special topic, project, and an appreciation of the mirrored links of mathematics with the other disciplines. This begins during his time as a teacher at St. Stephen College, and it was his focus during the years spent with the Mathematical Sciences Foundation. He is associated with MTTS, that is Mathematics Training and Talent Search Program, sponsored by National Board of Higher Mathematics, a well-known program for all the mathematics students in India. He often served as a resident faculty for this program. In fact, I met him first time in MTTS program in Mysore, where I was also served as a faculty. There I have realized that he is not only a good mathematician, but he is a very good photographer, and photography is his passion after the mathematics. In India, people who think mathematics as a pure one, and they treat the others as a second-class mathematician, especially those who are interested in applying mathematics to solve problem in real life. When it comes to the subject like physics, chemistry, or economics, they may be okay with it, but not for the finance. Finance or mathematical finance is not taken as a proper mathematics to many of our so-called mathematicians. But fact is, mathematics has been applied to the problem involving loans and investment from very early times. The Mesopotamians were calculating compound interest around 2000 BC. Later in India and China, problems of debt were used to motivate negative numbers. The connection have only strengthened with time, and the flow of ideas has been especially rich in the last century. For analyzing stock market data technique, for big data analysis required knowledge of mathematics, statistics, computer science together. Where the topic like graph theory, topology, multivariate calculus plays a very important role. With this introduction, I request Professor Habib to start his lecture. Thank you, sir. Please start your lecture.
Okay. Thank you, Father Xavier, especially though you have taken away some slide from my lecture with your comments. But I think it's all to the good. It will save me some time and effort as well. Deeptiman, thank you for inviting me here and for all the things you have just said. Sucharita, also, thanks for all the organization. So let me share my slides and let's get started. Okay, so is this fine? Can you see them?
Yes.
Yes.
Okay.
Yeah.
Okay, great. Okay, now, this subtitle about profiting from randomness is something that I hope will become clearer as we go along in the talk. Randomness is generally something that we are afraid of, right? It's a lack of predictability, and we like our lives to be predictable. But at the same time, if good things are to happen and if you are to benefit from them, a bit of randomness is essential. If everything is completely fixed, then that's it. I mean, there's no good or bad that can happen beyond that, at least as far as things like finance are concerned. Okay, now let me first give some broad questions that one takes up when one does finance. This will be very broad, and then I will talk a little bit about the kind of mathematics that one needs to deal with these. And then we will get started with some actual basic concepts in finance. So I will do things from scratch. And there is no prerequisite knowledge that's needed here from finance or economics. And very basic mathematics, if you know your differential calculus a bit and you know some basic probability, then that's about all that we need for today's lecture. And one of the interesting things about finance is that one can get started with very little background knowledge, and one can go quite deep with it as long as one thinks in the right ways. Okay. So what is finance about? Finance, generally has two aspects. One is accounting, keeping track of what you have and what you should get, what you owe people. That is not what I'll be talking about today. What I'll be talking about is the other aspect of finance, which is about making investments and about the goal of investing towards future gains. And as you know, there are many, many ways to do this. You could, if you had some money, what could you do with it? You could put it in a bank in various ways. You could buy bonds, you could buy shares, you could invest in land, you could invest in some startup company, you could invest in commodities, potatoes, wheat, oil, okay, gold, I think I already mentioned. So there's so many things to do where you can put your money and you can hope that after a while you will get back more than you put in. Now that is generally what finance is about, but then there are many specific aspects that one has to think about. One is, of course, that once you are trying to make a profit and get back more than you put in, then you want as much of this as possible. So one tries to plan in a way that will maximize the expected gains from your investment activity. All right. Well, and we also know that things don't always work out, right? So you make plans, but they need not happen. And so you invest in shares, and you have seen maybe that over time, some particular share has grown in value a lot every year. And therefore, you invest in it, hoping that you will also benefit from this repeating in the next year, but then maybe it does not repeat. Circumstances change. And so when you attempt to make a profit, you also have to face the possibility of loss. And this is what we call risk here, right? So risk broadly is uncertainty. You attempt to make a profit, but then you open yourself up to loss, and you don't exactly know beforehand which of these is going to happen. So that is risk. And one of the key things one has to do in finance is to measure how much risk we are exposed to, and risk can come from different sources and can be of different types. So we want to measure this risk, and through this measurement, we want to moderate our activities so that we can manage this risk. Right? So we keep the risk to acceptable levels. You must take risk is unavoidable, but you want to keep it at acceptable levels. Yeah. And now you have two competing desires. You want to maximize the profit that you might get. At the same time, you want, of course, to keep the risk as low as possible. And so you look for combinations of investments. You invest in different things so that the combination is good in both ways, so that the expected gains are high, but the risks are low. And as we will soon see, this is a difficult thing. In general, if you try to do one of these good things, then the other one becomes difficult to achieve. So it's generally unlikely that you will be able to do both, and you will have to decide which balance you want to go for. Okay, so when we say identify optimal combinations of investments, one part of this is that you have to decide what level of risk you are willing to live with, or what is the minimum profit that you feel you must shoot for. And then you have to design your investments accordingly. Okay, and then another thing is that if you're aiming to get some profit in the future, then which future are we talking about? Are we talking about next month, next year, 20 years from now, your retirement time? And this will also affect the kind of investments you go for, right? And what you consider to be optimal. And one of the interesting things that happens is that repeated short-term investments. So if I have a strategy that works well for a year, then you might say, well, repeat that strategy every year for 10 years if you want something good for 10 years. And funny thing is that that probably will not work out. So the strategy that is optimal for 10 years will generally not be the same as what would happen if you tried the optimal 1 year strategy 10 times in succession. So there are various subtleties, various difficulties that one has to live with. Okay. And finally, how are you going to create a strategy? You will look at the past. What else can you do? You can look at the present situation, and you can look at the past, and you can see what has happened. You can look at the data, and from the data about the past, you attempt to predict the future, right? And that in itself is a big issue. Does the data about the past capture enough for you to predict the future? And when I say data about the past, which past? So data for the past month, data for the past year, data for the past 100 years. Right? So these are in some sense unresolvable issues. Okay, and they create a lot of what you could consider the gray areas of finance that make it difficult and complicated to operate within it. Okay. Now, having said something about what are the broad issues that concern us in the world of finance, let's take a look at what kind of mathematics people use to deal with them. Okay, I'll just list the topics here. It's impossible to get into details of them in an introductory talk. Some things we will see later, of course. Since we are going to be dealing with uncertainty, I think it's obvious that probability and statistics will certainly be involved in talking about finance. Probability is the language you need to talk about random situations. What is less obvious is that differential equations have a role to play. What happens is, take something like physics. So how do differential equations come into play? Well, you have certain basic laws, basic principles, and you try to express them in mathematically through rates of change. And that is how differential equations are created. The interesting thing is that finance also has certain principles which can be interpreted in terms of certain rates of change. And so these can also lead to differential equations. Okay, so, but this is investment by investment. So a certain investment may lead to a certain differential equation, a certain other kind of investment may lead to another differential equation. And so these have a role to play. But the third item, stochastic differential equations, comes into play because you are not dealing with regular fixed processes like you do in calculus. You are dealing with processes which have randomness. And so there is an area of mathematics called stochastic differential equations, which deals with the right kind of differential equations, the right language for differential equations for situations with randomness. So that gets involved. Measure theory is basically the modern language which is needed to talk about probability. And it has an important role to play in finance as well. So one of the interesting things is that the kind of probability that you learn in, say, in your BSc mathematics prop stats courses is useful for finance, yes. But there is a stage at which you run into a wall, and to get beyond that, you need, in fact, your theoretical knowledge of probability to be at a deeper level. And you need to learn probability as expressed in the language of measure theory, even to talk about some of the processes of modern finance. Okay. Function analysis is linear algebra in infinite dimensions, and it comes into play in modern finance in different ways. One is that if you're dealing with a universe where there are many assets, many different ways of investing. So, do you count them? One theoretical way out is to just say, let's assume there are infinitely many and let's see what we can do. And that takes you to function analysis. The other thing is you end up dealing with collections of functions, random variables, and so on. And they could be infinitely many independent ones of those. And so function analysis, which again is generally considered to be very much a part of pure mathematics, and at best as something with applications in theoretical physics, comes into play, in fact, even in finance. And if you were to join, say, a PhD program in finance, you would probably be asked, if it was a mathematically oriented program, one of the first things they would ask you is whether you have done any function analysis. Okay. Optimization, okay, it's like probability and statistics. It's fairly obvious why we should have optimization questions to settle here, because you'll be trying to maximize your profit, you'll be trying to minimize your risk, and that is how optimization enters this game. Numerical analysis, anytime you deal with the real world, it's all very well to have theoretical formulas, but to actually apply them to data and to do computations on a large scale and to do them quickly, you need all the tricks and techniques of numerical analysis. Okay. And finally, data science, which is perhaps not a well-defined piece of mathematics as such, but it's a popular term now. And let me, in fact, I've put in a whole slide for data science. Let's just say something briefly about how what data science could be considered to be and why it would be involved in dealing with finance. Okay. Now, if you Google and you look for definitions of data science, you will find many different definitions. So let's not go there. Let's not try to define what is data science. Let's just see examples. And I'll do it in a very simple way by simply taking a book, which is considered to be a Bible for data science, as far as mathematicians and computer scientists are concerned. This book, Foundations of Data Science by Bloom, Hofroth, and Kannan. And let's take a look at the table of contents and see what it talks about. Okay, it talks about high dimensional spaces because your data nowadays tends to measure many different properties of something simultaneously. So you need to work with high dimensional space. You need to look for relations within these high dimensions. And so there are many other topics: best fit subspaces, singular value decomposition. This is basically linear algebra. Right? There's a kind of formal probability, random walks and Markov chains. There's machine learning, algorithms for massive data problems, clustering. Clustering is when you try to see, for instance, suppose you are investing in different shares and which shares are closely related to each other, have similar properties. Can you mathematically figure out these relationships? So that is what happens in clustering. Random graphs, I'll say a little bit about this later. Wavelets, again, something that is used to make a technical tool that is useful in making sense of these things. So anyway, you see a lot of advanced mathematics here. And maybe if I go back to my previous slide, I highlighted some things, I put them in bold, and that is because these are the things that you would most likely learn during your undergraduate studies in any case, right? Prof stats, some differential equations, optimization, linear programming, maybe quadratic programming, numerical analysis, right? Things like measure theory, function analysis would be very standard courses in a master's program. Things like stochastic differential equations generally would not be a compulsory course for anyone, but it could be available as an elective course at master's level in various places. So certainly, if you do an applications-oriented master's program, you would have learned a lot about the basic maths that's needed in finance. But even as an undergraduate, you already would know quite a bit and can make sense of finance. You at least know enough maths to look into finance in a serious way. If you have projects in your program, you could do a final project using the maths you already know on some interesting part of finance. And you could figure out whether this is something that you want to spend your life on. Right? It's quite possible to learn enough finance as an undergraduate to make decisions of this type. Or else put it off for a year or two, do an applied maths master's, and then definitely you would know enough. Okay. So I think this is a bit of background about what are the issues one takes up in finance and what is the kind of mathematics that would be used in dealing with those issues. Okay. And it is true that as those slides indicate that the world of finance has gradually been becoming more and more mathematized. And so it's quite common to find headlines like the ones I'm showing you from American media, sort of alarmist that math nerds are taking over Wall Street. And that was an article saying that people with math PhDs, or else PhDs maybe in economics and physics, but with a high mathematics quotient, are becoming the key players on Wall Street. Okay. But as they become more powerful, they're also catching more of the blame when things go wrong. And so you also have headlines like below following one of the crashes that happen from time to time on the stock market, how mathematics might have caused the financial crisis. How can mathematics cause a crisis? Well, it depends on how you use it. And at the end of the lecture, we'll be in position to see also, what is the danger that goes along with the good stuff. Okay, All right, let's get started with some actual finance, right? So as I said, there are many ways of investing, but let's just look at one of them. Let's look at buying and selling shares. So first of all, what are shares? So when you buy a share, what is it that you are getting? On paper, you are becoming the part owner of something, of a firm. And ownership of this share entitles you to part of the profits made by the firm. There are different kinds of shares. Some of them make you, say that, well, if you are going to share in the profits, then you will also unfortunately have to share in the losses. So if the company ends up behind, you might end up liable for the losses as well. But these are not the shares we are thinking of when we say, okay, invest in Reliance or Tata's or whatever. We are thinking of what is called common stock, which comes with no liability for losses. But at the same time, then you have lower priority for your share in the profits. If you have common stock, it's quite possible that the company makes profits and you do not get anything. Your share directly from the profits is zero. You do not get a dividend. But on the other hand, if the company does well, the share price would rise, the value of the share would rise. And that is how you could make your profit, by selling your share at a higher price than the one you bought it, and not from your direct share in the company's profits. Okay. So we'll come back to shares. So this is the kind of investment we will look at. But now let's look also at this thing of, how do you evaluate your profit? Now, if I tell you that here are two investments and one of them will profit you, you put in your money and one of them will get you rupees 100 and the other one will get you rupees 10,000. Is the rupees 10,000 one really better? Well, depends how much you had to invest to get that rupees 10,000, right? So if you had to invest a lot to get that 10,000, then maybe it's not really that great. So you don't just ask how much profit, you ask how much profit per rupee that I invested, right? So if I invested 1,000 rupees, I want to know what I got, and I look at it on a per rupee basis. And that way I have sort of a common way to evaluate every investment. Okay. So that is one thing that we will do. The other is that suppose what you will get back is not certain. Okay, so there is some uncertainty. Then how do you compare? Because something may say I'll give you 100, but maybe I'll give you nothing. And something else says I'll give you 200, or maybe I'll give you 50. Now, how do you compare these two? Because it may happen that you get 200 from the second one, or it may happen that you get 50 from the second one, but 100 from the first one. Right? So how do you decide between them? So let's look at a certain scenario of this kind. Okay. Let's imagine that there are three investments, A, B, C. Let's imagine that all three are available to you for free, or maybe for the same price. So that we can take out of the equation. And let's look only at what you might get at the end. Okay, and let's say that from investment A, you have a 50% chance of getting a profit of 100, but you also have a 50% chance of a loss of 100. B says 50% chance of a profit of 100, 50% chance of a loss of 10. And C says 90% for 100, 10% of 100 profit and loss. Well, we can look at the different choices and see. For instance, if I were to compare A and B, the chance for profit is the same. The chance of loss is the same, but the amount of loss in B is less. So I would probably, it would be sensible to prefer B to A, right? Okay, that's good. Let's look at A and C. Now, A and C both have the same amount of profit and loss. But C has a higher probability of the profit and a lower probability of the loss. So it would make sense to prefer C over A. Okay. It's less obvious how to compare B with C, right? B is promising lower loss, so that is good. But the probability of that loss is higher, so that is bad, right? And so it's not so clear-cut between B and C as to which is the better investment to shoot for. So maybe we need to think a little bit more and come up with what could be the parameters for our decisions. How should we think about random investments, and then we can come back and revisit A, B, C. Right? Some things we could see can be determined purely by common sense, but some things are not so obvious. Okay. Well, looking at this situation again, we can look at it in a different way, and we can say, suppose I had this investment opportunity repeatedly, right? Then which one should I go for? Then it would make sense to say, go for the one which on average does better. How do you judge what does better on average? Well, in probability, the concept for this is what you call expectation or mean of a random variable. What is that? If you have 50% chance of a gain of 100 and 50% chance of a loss of 100, you multiply each outcome by its probability and you sum up. The idea is that the probability measures relative frequency. And so by multiplying probabilities and adding up, you are actually measuring on average what will you get if you invest in this repeatedly. Now for A, if you compute expectation like this, okay, what will happen? You'll have 0.5 times 100 and then 0.5 times minus 100 for the loss, and you sum up, you will get 0. And so in A, right, as we can see, if you repeat, in the 50-50 for profit and loss will tend to cancel out in the long run. And so in the long run, you don't expect any profit or loss from A, and the expectation therefore is 0. Okay. Now, what is it for B, right? So you could compute it in a similar way for B, and you see that B promises you an average profit of 45 if you were to do it repeatedly. And C does 80. Okay. So if we decide that average profit is the way to go by which we will judge different investments, right, the expected profit, then between A, B, and C, C is the one that we would go for. Okay. Okay. Now suppose, as we said earlier, it's not only how much you got, but how much you invested. So you have to see what you got per rupee that you invested. And that we will have a name for. We will call it the rate of return. Okay. So suppose something initially cost U and then had value U, and after a while had value V. So the gain from the change of value is V minus U. And you see what it is compared to the starting amount U. So you see V minus U divided by U. We typically denote it by R, and we call it the rate of return over the investment period. So this is what we will use to compare different investments. Now, of course, what something is worth today, I might know, but what it will be worth in the future, I do not know. So this V at any point of time is actually something unknown, and therefore we can treat it as a random variable with different possible values, with different corresponding probabilities. And if V is a random variable, then this expression V minus U divided by U is also a random variable. So this rate of return is a random variable for the particular investment that we are looking at. And we would try to judge between different investments by looking at the properties of their rates of return as random variables. Okay. Now, what we have already sort of reached is that one of the things we will look at is the expectation of this rate of return. And we would like the expected rate of return to be high. Okay. Now, until the early part of the 20th century, this is what the textbooks used to say. And this is all they used to say. They used to say, invest according to the expected rate of return. So find the investment with the highest expected rate of return. That is the best thing to do. Invest in that. At the same time, actual investors knew that this was bad advice. So there is a gap between what the textbooks say and what people who are actually dealing with the real world would consider sensible. So someone with a theoretical bent of mind was giving this advice, and many people were. And investors knew that they can't follow this because no investor will put all their money into just one investment. Because if that goes south, then you are completely sunk. So everyone would like to actually balance their investments across various things, right? Different shares, bonds, bank accounts, gold, some mix. And you would try to create a mix which overall has good properties. Yeah. Right. So this was the situation 100 years ago. The textbooks were saying one thing. Actually, investors knew that the textbooks could not be followed. Okay. And this was not resolved properly until 1952 by a young fellow called Harry Markowitz. Okay. Markowitz had signed on to do a PhD in operations research, and he was looking for what thesis he could work on, what could be the problem to work on. He was a bit lost. He was looking at different things. One day he had gone to meet his supervisor and found and had to wait a little bit before the supervisor was free, and found that there was also a broker who had come to meet his supervisor. And they got to chatting, and the broker pointed out that, there is no good theory for what we do. And what the textbooks say is one thing, and we all know we can't follow that. And it would be great if someone could come up with some theory that was actually useful. And Markowitz began to think about this problem due to that chance conversation. Okay. And we'll soon see what it is that he came up with. Okay, now what is risk? Risk, as I said, is unpredictability, right? You don't know the future prices and values, and that is risk. How do you typically assess uncertainty? Well, in probability, the standard way of assessing how much uncertainty is associated to a random variable is standard deviation or variance, right? So you look at a certain fluctuating quantity and you calculate its standard deviation. And if the standard deviation is low, that means the amount of fluctuation is low. And if the standard deviation is high, that means the amount of fluctuation is high. And you can apply that principle to risk. So what we can do is we can look at the rate of return, which is a random variable. And to judge the associated risk, we can compute the standard deviation for that random variable. So let us look at the return. Now here we are ignoring the initial investment. Let's just look at the return, right? The payoff, and how much fluctuation is built into that. Right? Now, standard deviation, you would have learned in probability how to compute. I'm just going to give you the answers for that. So if you were to compute standard deviation for the payoffs for the first portfolio, you would find that the standard deviation is 100. Do it for the second one, you find it's 55. Do it for the third one, you find it's 60. Right? Now remember that the tricky one was choosing between B and C. They were both better than A. So it came down to choosing between B and C. In terms of average return, C was better by a lot. But what we see now is that in terms of risk, C is worse. C is exposing you to a bit more risk than B is. And now here, the investor's appetite and what the investor can face comes into play. Can the investor If the investor can face the higher risk that C requires, then the investor can go for the higher profit that it also promises. But if you can't, then you better stick with B. So what happens now is that unlike most math problems where it's completely external to the person doing the analysis, right? There's a problem and you analyze, you create some equations, you solve, everyone gets the same answers. Here is a little bit different because what you want is also important in terms of deciding what you can go with and what is optimal. Okay. And as we just saw, right, so of course, we want high return, we want low standard deviation. As we just saw an example, the relationship goes the other way. Those investments which promise higher expected return generally also ask you to take more risk. Okay, so shooting for higher profit involves taking greater risk, and this seems to be unavoidable. Here's an example, a numerical sort of some numerical evidence in favor of what I just said. And this is data from the US market, looking at investments of different types. Let's start from the right. So one is, if you had some money, it suffers due to inflation. So whatever profit something is getting you has to be measured off against inflation, right? What it gets you once inflation is taken into account is what matters. Okay. Where can you invest if you're in the US? Here are some standard things. One of these things called treasury bills, which are short-term bonds sold by the treasury, by the government bank of the US, all right, by the US treasury. And they are considered to be extremely safe because they are backed by the American government. But as one can see, because they are extremely safe, they hardly get you any profit. They barely keep up with inflation. Incidentally, for now, only look at the light gray bars. Those are talking about the mean returns. And you can see that treasury bill, the light gray bar for that, just a tiny bit above the inflation bar. And so if you avoid risk, you hardly get anything in return. Long-term government bonds, well, they are safe in the sense that whatever money was promised to you, you will get. But bonds have certain value, which depends on prevailing interest rates and other things. And those interest rates for the future are unknown. And for longer bonds, they have a greater role to play. So there is some uncertainty with long-term government bonds. And these are right. And so you can now the dark gray bar is measuring the risk part. So you can see the long-term government bonds are getting you on average more profit, but are also asking you to take more risk. And this continues. Large stocks means stocks in large companies. So large companies means well-established ones, right? And these are low risk compared to others. They have been around for a while. They are stable. But then the share price is also unlikely to shoot up a lot. That will also be stable. Right? If you really want to make high profits, what you have to go for are things like startups. You have to catch a company when it's small, when its share value is low. And then if you catch the right company at the right time, then you might get a large profit after a while. But naturally, these companies are also the ones which fail a lot and so have a lot of risk associated with them. Okay, so this is a general illustration of how high risk and high profit tend to go together, right? And you can't just be greedy. If you're going to be greedy, you also have to be pretty brave. Okay. Now, what's the task? The task is you need to make up, you or investor, let me say we need to make up our mind about what we are shooting for and what we can live with. For instance, we might say that I can live with a certain level of risk. I can live with a certain level of standard deviation. And then I can try to decide for that level of risk, what is the best combination? So maximize the expected return at a given level or standard deviation. But it may also happen that I'm a bit desperate. I'm investing. I'm a little bit desperate. For some, I need to raise money a bit quickly, and therefore I have to shoot for a certain minimum level of expected return. It's no use to me to shoot for less. And if I'm in that situation, then for that level of expected return, I would try to find out which is the best combination, in the sense, which is the combination that minimizes the standard deviation at the given level of expected return. Okay, so we need to see how these two things play off against each other. And what we should do if we have two quantities and we need to see how they play off against each other, we should create a Cartesian plane, two coordinate axes, one for each quantity. And we should see how things plot, at which locations they plot, and we should look for patterns within those plots. So that is what we will do now. We will create things that are called portfolio diagrams. Okay. Anyway, again, this is what Harry Markowitz did, right? This formulation, the decision that it's not just expected return, but also the standard deviation that you must look at. And that these are the two choices that we have to struggle with. So this formulation is due to Markowitz, and its resolution is also due to Markowitz. He did his PhD in 1952. And as was mentioned, even he had trouble with this, even though it was revolutionary work, but people didn't know how to classify it. So when he presented his thesis, the audience was mathematicians and economists. And the economists said that there is no new economics principle here. And the mathematicians said there is new mathematics here. So what do we give you a PhD in? And then he was asked to leave the room. And for a long time, people inside fought about whether he should get a PhD and what his PhD should be in. Okay. But ultimately, he was given his PhD, and it turned out to be quite revolutionary in the world of finance. And ultimately, he received a Nobel Prize in economics for it. So at least ultimately, people knew what subject it belongs to. Okay, so we'll use this. We'll make these portfolio diagrams involving the expected rate of return and the standard deviation of the rate of return. Given some asset in which you would want to invest, we will plot it on this diagram, right? According to its sigma, its risk level, and its R bar, its expected rate of return. Now imagine that you had 4 assets which plotted like this. Which ones would you like, right? Which ones would be preferred? So there's like A, B, C, D, ABC that we looked at. Now you see between A and B, it should be clear that generally one would prefer A, right? Because it's offering, A and B offer you the same expected profit, but A does it at a lower risk level. So probably prefer A to B. Prefer A to C because it promises you more profit at the same risk level. Similarly, one would prefer C to D and B to D. What is not clear is how one would, well, let's see, and A to D is also clear, right? Because A is certainly better on both counts. Higher profit, lower risk. What is unclear is between B and C, what one should do. B promises you more, but at a higher risk level, right? Okay. So these are the biases that one would have, right? One would prefer A over C, B over D. These are given certain names, non-satiation. Non-satiation meaning I would prefer more profit to less profit. I would not be satiated by a certain level of profit. A over B, C over D is risk aversion. One prefers lower risk in general. So the basic when people do general analysis in finance, they assume that investors are always non-satiable. But it's not exactly okay to assume that they're always risk averse, because sometimes investors actually do go for the thing with higher risk. And anyone who has bought a lottery ticket, for example, has opted for a situation where the risk is extremely high. I still gone for it because the profit seemed high enough, possible profit seemed high enough to justify that insane amount of risk. Okay, so risk preferring behavior can happen like in lottery tickets, and that is what this slide was about. Let's not spend too much time on it. But generally, what you would want is that if you're comparing the rates of the expected return and the risk, you would prefer an investment if on one count it was no worse than the other, and on the other count was definitely better. Right? And if, right, so there are two ways in which this could happen. Okay. And if investment is better than another in either of these two ways, we say that it dominates the other one. So what do we look for? We look for assets which are optimal in the sense that nothing dominates them, because if something dominates an asset, then go for the one which is dominant, right? That's better. So we look for assets which are not dominated by anything else, and then we choose amongst these. Okay. Okay. So these optimization problems can be handled with basic statistics and multivariable calculus. I believe I should run through a few slides so that I can have some time for a few serious things at the end. You know that in Prof stats, if you have sum of random variables, then expectation adds, and variance has a certain formula involving covariance, which is written on these slides. So you can take these formulas, and this was the new thing that Markowitz did compared to earlier things. He realized that these formulas are relevant for finance. Okay. So what can you do? You can take a certain number of assets and you can combine them in different amounts. The relative amount that you put into each asset is called its weight. And so your total investment is, whatever the total, that sum of everything that you put into each asset. The weight is the proportion that you invested in any asset. Weights could be negative also. For instance, if you owe something, that would be a negative weight. And based on knowledge of the weights and the rates of return of each asset, you can compute the rate of return of the overall asset. And it turns out to have a very simple formula. Whatever were the weights for the individual asset, you take those weights, you multiply with the corresponding rate of return, you sum up, and you get the total rate of return for the portfolio. This can be easily derived in two lines. But anyway, the good thing is there's a nice linear equation for the total rate of return from the portfolio. Okay. Now, and therefore we can then compute the mean of this and the standard deviation of this, and we can investigate those quantities, right? So mean and then variance and standard deviation by those formulas. So these are all computable. That's the good news. And very quickly, let's look at a numerical example with two assets. So suppose there were assets A and B with the given rates of return and these standard deviations. You could mix them up with some weights. Now, since the weights are the proportion invested, the total of all the weights is always 1. So if there are two assets and the weight for one is W, then the weight for the other one is automatically 1 minus W. So you get into a situation where there's just one thing you are varying, the W for one asset, and you can see how things vary according to this, and you can maximize, minimize accordingly. Okay, here's the interesting thing that happens. Okay, here are the application of the formulas. Let's skip all this and let me take you to the picture. That if these were my A and B and I took different combinations and plotted their R bar and sigma, a hyperbola gets created like this, and it extends above also. Okay. Now remember that the more you are on the right, the higher risk you are taking. The higher you are, vertically, the more the expected profit that you have. So one interesting point is this one, right? The vertex of this hyperbola. That is the one which overall minimizes risk. So if you had to work with just these two assets and you were extremely risk averse, you wanted to minimize your risk, you would take this particular combination, okay, which minimizes the sigma. But if you're willing to live with higher risk, you could go for ones here. You would never go for anything on the lower arm, because if you were considering, say, this point, it would of course be more sensible to cover the point use the point immediately and above, which would promise you greater profit at the same risk level. So it's really only the upper arm of the hyperbola which you would ever invest in. Now you can continue and you can do similar computations with 3 assets, and if you know their rates of return, their covariances and variances. And what we are seeing here is just 100 odd random combinations of these ABC. And you see that it's not like the whole R sigma plane gets filled out, a particular part of it gets filled out. It looks like there's some boundary here, and then inside it you are filling up. There seems to be a boundary. I've just drawn this by hand, roughly located something like this. One would be interested in computing this boundary and seeing exactly where it is, because then the best portfolios would be the ones which plot on the upper arm of this boundary. Okay. Now this is the general. So let's look at the problem in this from this viewpoint, that we want to minimize the risk at a given level of rate of return. So there's a certain thing you want to minimize, and here are some constraints. This is exactly the kind of thing that the method of Lagrange multipliers in calculus is set up for. So you apply it here, and you can sort of see what will happen. You see, this is a quadratic. The things that you can vary are Wi and Wj. So this is an expression, a polynomial of second order. Lagrange multiplier makes you take the partial derivative. So when you differentiate a quadratic, you will get a linear thing. So in Lagrange multipliers, this part will become linear. The constraints, if you look at them, are already linear. And so applying Lagrange multipliers here, very interestingly, just gives you a system of linear equations to be solved. Okay. And so you get a certain number of linear equations in a certain number of variables, the weights and the R bar and the C. Okay. Okay. Now, what happens when you solve linear systems? Okay. Well, one interesting thing that happens with linear systems is that certain linear combinations, for example, suppose it was a matrix A and you solved AX equal to B, and you did it twice. So you solved and you got AX equal to B, and you also got AY equal to B. Well, then X plus Y is not a solution, because AX plus Y will give you 2B. But if you took A half X plus half Y, you would again get B. So many linear combinations would again, so if you know 2 solutions, you get many others, right? So you can generate a whole bunch of solutions if you have 2. Okay. So if you can find 2 minimum variance portfolios by taking their combinations like this, you can create other minimum variance portfolios. Okay. But if you take combinations of 2, you know you get a hyperbola. So this completes the picture. It tells you that all the combinations you can create will actually be bounded by a hyperbola. And the efficient ones, the ideal ones that you want to shoot for, are the ones which are on the upper half of this hyperbola. That is called the efficient frontier. Okay. Okay, so that is what Markowitz taught us to do. And a lot of modern finance is based on exactly these computations. You add more details, okay, and you fine tune in many, many ways. Which asset should you look for, working with particular sectors and so forth. But this is the core of it. Okay. And for instance, as an example, I would mention that years ago, a student who had done a course on these topics with me, she went for a summer internship at one of the famous investment banks. And she was assigned to work in the unit which looks at corporate mergers, right? And so the issue is, if one company is trying to buy out another, right, and have it merge with themselves, how much should they pay for it? Okay, and they had a thick handbook for doing those calculations, and she was not, it was completely confidential. But once she saw what was inside, she couldn't resist. So she smuggled it out of the office and she brought it to the college to show me, to show that the things that we had been doing in class, they were exactly the ones that were being used even now, 60 years after they were first created, uh, with various modifications and so on. But the core was exactly this, what I have shown. Anyway, I couldn't keep a copy or anything. It was confidential, but it was very interesting to see that it's not actually just theory, and people are using it in a very serious way in today's world. Okay. Okay. Now we come to a certain problem, which is it's all very well for me to say, take the standard deviation, take the rate of return, do some computation. Where do I get these numbers? Where does the expected rate of return come from? Where do the variances and covariances come from? They will come from data of how the share prices have fluctuated, say, in the last few years. But when you get some numbers out of data, those numbers are random, and you have to worry about how reliable they are. Okay, so you might see certain covariances, but the trouble is that even if the covariances, if the shares were completely independent of each other and the actual covariances underlying the relationship was zero, when you look at particular data, you will not see zero, you will see some non-zero number. That's because of the randomness. Okay. So even if I'm seeing some covariances, are they real? Right? Can I decide such things? Because that would be vital to knowing whether the calculations we are making have any real significance, right? And there are mathematical ways to make these judgments, right? I just want to briefly mention this one. So you can do an investigation. You can say, well, suppose the assets were independent, right? There would be a matrix of covariances, and it would be zero. But you could actually calculate what are the properties of this matrix. And for instance, you could look at the eigenvalues. Entries are random, so the eigenvalues are also random. They would have some probability distribution. And it has been worked out that there is something called the Marchenko-Pastur distribution, which the eigenvalues would have if the entries of the matrix were random and were independent of each other. So then you can look at your data, you can look at portions of your data and look at eigenvalues at different times and see which eigenvalues are more common, less common, right? How often they show up. And you can look at those relative frequencies and you can compare with the Marchenko-Pastur distribution. And this is something from actual data that a colleague of mine calculated while working with data from the National Stock Exchange. She was working on exactly these issues. And the bottom row is how the eigenvalues would be distributed, their probability distributions, if the covariances were spurious, right? And you would see data like that. And then you see the ones you get from the actual data, and you see it's not quite like that. And you can, this is just visual, you can do more detailed calculations to really see that there is a difference. But this is just the visual aspect. You can see there's a bit of a difference. And so the correlations are not entirely spurious, and it makes sense to do various calculations based on it. Is an example of the kind of things that maths can help you out with while working with finance. And this is an instance of something I mentioned earlier called random matrix theory coming into play in this particular problem. Okay. Okay, I think I should be close to finishing. I've gone a little long, but we are quite close to finishing. So there are certain practical issues. Statistical estimation that is crucial in finance requires knowledge of the underlying probability distributions. Now, standard practice when pricing things is to base everything on a normal distribution. Normal distribution has certain interesting features. One of them is that it dies out very quickly. This bell-shaped curve very quickly essentially hits zero, right? Becomes indistinguishable from the axis. And therefore, if things follow normal distribution, very extreme events are essentially impossible. They would be very, very rare. But extreme events in finance have not turned out to be as rare as they would be if things actually followed the normal distribution. Okay. And for instance, Benoit Mandelbrot, he's famous for his work on fractals. And in fact, one of the things which led him to fractals was this very problem of the normal distribution and what it predicts versus what you actually see. It led him to look for ways of describing more chaotic behavior than the normal distribution can capture, and that led him to the study of fractals. But here's a book on these things and some very striking examples. So if we follow theory, the way we have developed it, and if we assume things follow normal distribution, in the years between 1916 and 2003, if you looked at the Dow Jones Index in the US, okay, there should only have been around 58 days when the index moved by more than 3%. There were actually 1,000 such days. There was a huge gap. Okay, and here's another one. So as I said, extreme events should be rare. A swing of 7% should only happen once in 300,000 years if things are following the normal distribution. But he showed that it had happened 48 times within a single century. So extreme events are very common compared to what they should be. Okay, so then you can say, let's give up on the norm. Why are we being stupid and working with normal distributions? People have figured out the right kind of distributions. They have a name. They are called heavy-tailed stable distributions. But the problem is that they're hard to work with. You can compute to a certain extent, but it's very difficult to get theoretical insight out of these guys. Nobody has really succeeded in that yet. Mandelbrot has, for example, made enough of a case that these were the things to use, that these fit the data rather than normal distribution. That part is very convincing. But once you fit them to the data, how do you use them to understand processes? How do you use them to come up with theoretical understanding? That is still something that people have not been able to figure out. And so we are in a funny situation where people continue to use the normal distribution, even while being aware that it is not quite the right thing to do. There's a big problem that is waiting for someone to come along and give a new perspective which will resolve these issues. Okay, okay, so who is fit for the modern world of finance as far as such problems are concerned? So these are the people with PhDs or at least say masters in mathematics, physics, computer science, or economics, but definitely with a strong component of mathematics and abstract mathematics. A lot of what would be considered very pure mathematics. Now, these are the most highly paid people on Wall Street, but rather than luring you with promises of money, let me lure you with, well, there's money here also, but let me lure you with another kind of glory. Okay. So first, many of the Nobel Prizes in economics have gone to work in this direction, in the direction of quantitative and computational finance and its theoretical aspects as well. Okay. Starting from the 80s, when people finally became convinced that this is here to stay. Also because this is the time when computers began to really pervade people's offices and people started to use them in a much more serious way. So from the 80s onwards, there's another reason why the subject has taken off. So here are many names of people who have got Nobel by working in this sort of thing. It's interesting that many of them had their basic degrees in mathematics and physics. Okay. And even outside finance, just for the math students, people have continued to get Nobel Prizes in economics with their first or second degrees being from mathematics. Fisher Black, BSc, PhD in applied maths, William Vickrey, BS maths, Eric Maskin. So you can see all these names, these are all people who got the Nobel in economics at different times and with one or more degrees in mathematics. So that has been a crucial part of what they have done. They've not got this by leaving mathematics. They've got it by taking mathematics and finding new ways to use it within other disciplines. And that is one of the most exciting things that has been happening with mathematics recently. It always had a very close relationship with physics. And therefore, and following from that with some other sciences, with engineering. But in the last few decades, right, two other directions have really taken off. One, of course, is biology, which has become more and more mathematized. And the other one is finance. And it's amazing how much maths is contributing to finance. And true test of the strength of the relationship is that the finance problems are also coming, sort of giving us new ideas of what mathematical problems to look at, right? So mathematics is also developing due to its relationship with finance. Okay. And there are many nice books that you could look at even as undergraduate students. Okay, and I've put a few pictures up here, books that are suitable for undergraduates that don't require much beyond basic probability and calculus. And if they need to teach you more, they teach you more, right? So in the first top left, Leuenberger's Investment Science is a little low on mathematics, is more about the finance side, but it has many nice insights and you could use it to get an initial insight into finance. And then you could ramp up the mathematics that you involve with the subject. And others are different combinations of finance topics and mathematics topics. Okay. Okay, so let me stop here. If there are questions, I would be happy to take them, of course.
Thank you, Professor Habib. Can you hear me?
Yes, I can.
Okay. I got some question. One question is, what are the limitations encountered when you try to predict financial model mathematically?
Well, so I was trying to give some examples of that, right? So, see, there are some, whether it's finance or anything, right, where maths gets applied to the real world. One problem, fundamental problem always has is the data. Now, physicists have some advantage in the sense, at least, that data they collect within our lifespan can be taken to be about, a stage where the laws are not changing and so forth. With finance data, things are much more problematic because markets sort of, the fundamental parameters of markets change, their behaviors change. And suppose I want to predict something for the next month, right? Now, should I look at last month's data? Should I look at last year's data? Should I look at last 10 years? If you look at too little, then you feel uneasy that you have not taken enough into account. If you look at too much, you worry that the old data may not be relevant to what is going to happen now, right? So that's one thing. So people try to come up with different ways of averaging so that current data is given more importance than older data, and the past gradually stops contributing. But that is one fundamental issue. So there are attempts to deal with it, but here is one issue. Another issue is that your data is never complete. And for instance, a few times that I have obtained data from real world, you find parts of it which are obviously false. Data from excellent financial institutions. And what happens is that they miss certain data and they're selling you data. They will fill up something. Maybe they will fill up the last thing that they had. The blanks will be filled with those. Okay. Somebody somewhere will do something funny. So another is the reliability of data. Okay. Then once you get past the data and you come to theory, then the issue is that you can fit some things to your data and you can, right? But what is it okay to deduce from them? Okay. And this, for instance, is the kind of issue I was taking up at the end. You can fit these so-called stable distributions to financial data and you can get excellent fits. Okay. But with the normal, when I fit a normal distribution to data, two things are involved, the mean and the standard deviation. And I have some physical idea what mean and standard deviation stand for. So if you tell me I fit the normal variable to this data and the mean was this and the standard deviation was this, I immediately get some intuitive idea about what's happening with that data. With the heavy tail distributions, there are multiple parameters. And then you will tell me alpha is so much and beta is so much and something else is so much. And I don't really know what it means. I mean, it doesn't really have a clear intuitive idea for me what it stands for. Okay. And this is what people have struggled with, that they're able to fit to data, but they're not able to get theoretical or intuitive conclusions out of that about the data. So these are the kinds of things that we still lack. Mandelbrot has a program for, his program is to fill up these gaps. I think it's safe to say that the successes so far are very partial, and we are still a far way from full success on this account. And of course, there are many other finance problems that I didn't even talk about. So financial derivatives. The second book that is showing options, futures, and other derivatives. Right, so there are different contracts which are kind of different kinds of gambles on what might happen in the future. So you don't just invest directly in a share. Instead, you invest in a certain bet on what a share might do in the future. These things can be a kind of attempts. These things can be a sort of insurance, or they could be for speculation. But that is a big part of modern finance, and that has its own issues that I didn't talk at all about today.
Another question is, you spoke about low risk investment in stock, and those are long-term investment. So how does one mathematically determine the correct time to invest and sell the low risk stock? Is it possible really?
Well, yeah, so, what is, so here is where, you have to decide for yourself a certain thing, and nobody can help you out for that. And the thing you have to decide for yourself is what kind of game you want to play, right? Now, let's say that you have some steady income, but what you're worried about is how much money you will have on retirement. Let's imagine that you have, say, 30 years left for retirement. Okay. Then the advice would be, don't think about when to sell, but think about what is the most stable investment you can make and just stick to it. And even if it does badly for a while, just stick with it. Or maybe not one, say 5 or 6, and stick to them. Okay. And then if you decide that here are 5 or 6 companies, I feel they'll be around in 30 years. Remember, no one can guarantee that, but suppose you make that. What the finance formulas can help you do is for those 5 or 6, they can tell you what is the optimal combination to go for. Okay? But then the basic advice will be do not sell until you actually need the money. Don't try to go for timing. Now, the timing game is played by a very different kind of investor. These are called day traders, and the game they play is that always try to figure out what's going up, what's going down, and to make quick profits based on that. Okay? That's a very dicey game. Large number of people are playing it. The theoretical advice generally is don't play this game. Okay, but people ignore that and play it. And then, of course, a few of them do well, and so those get publicized. But a large number don't, and that does not get publicized. Okay. So if you ask others for advice, then I think good advice is only this. Okay. The people who can afford to play these games are the large financial institutions, not small scale investors. And the reason is that only if you play it on a large enough scale does the statistics become something that you can rely on. Okay? If you're going to invest in 1 or 2 or 3 or 10 things, statistics does not really have a chance to kick in properly and give you solid advice. It will do some calculations and give you some numbers. The reliability is low. But if you have resources, you can invest in 200 things, and you have a bank of computers which can automatically, do various computations and do the trades automatically. Then you can play this game, and you can look for mismatches within a market, between different markets, and you can try to make profits. Okay, that is a game that the serious investors play. It is still a dangerous game. Again, there are famous stories of people who were supposed to be very, very good at it, did very well for a while, and one fine day lost everything. Okay. So, okay. I mean, it's a dangerous world. My advice would be, do it as a mathematician, not as an investor. So come up with things for other people to use, sell the tools to them, okay, and get your money from what they pay you for the tools, rather than putting your own money into play. And you can do quite well this way.
So another question is, you are talking about this correlation matrix or covariance matrix, rho ij. So that depends on the previous data. Now,
Yes.
Previous data means if I take few stocks, so those companies generated, someone is 50 years before, someone is 20 years before, someone is 10 years before. So how can I incorporate all these things together?
Yeah, so that is something that basically would be a research problem for any situation. Okay. But you can, if you have the data, the thing is, of course, you would generally use the same amount of data for everyone.
Okay, so minimum one.
Longer data may be available for some, but you would use the same amount for everybody. And once you start doing your computation, these one of the things to explore would be, what is my result if I use 2 years of data? What is my result if I use 4 years of data?
Yeah.
Right? How stable are my results? How much do they depend on the amount of data that I use? Okay. Second, the thing that you would do is that if you had a particular model that you were trying to convince people is good, then the honest test would be something like this, that you would look at data from, say, you would ignore what happened in the last year, let us say. And you would look at data that starts, say, 5 years back and goes up to 1 year ago. And you would apply your model to that data. And you would see what it says about the subsequent year. Then you would see what actually happened in that year and how it compared with what your model had said should be happening in that year. And you might do this many times for different time periods in different countries, for different sectors of the market. Right? So you'd have to do it. you wouldn't just do one thing and let it go. You would have a way of thinking, and you would see what that way of thinking would do if you applied it in different contexts, in different time periods. And if overall you could make a solid case that generally it has worked well, then you could succeed in convincing people to try it out for the future. Okay.
Okay. Another question is, how can one incorporate the risk appetite into this model? So somebody has different risk appetite. I can take much risk. So how that can be incorporated in this model?
Okay, well, maybe I should scroll back a bit. So let's look at this picture. And this curve that I drew by hand, as we saw later, would actually be a hyperbola, and you would have an equation for it. Okay. And the top half is what we are interested in. Now, your risk appetite decides where you are placed on the horizontal axis, because that is the sigma axis, the standard deviation, right? Now, suppose you were placed at 0.1. Suppose you decided that's the risk level you were willing to go for. Then you would look at what's happening above 0.1, and you would look at the topmost point, and you would see what combination of ABC lands you at that point. That's the combination that you would go for. Okay. If you could settle, if you were willing to handle 0.2 level of sigma, then you would look above that and you would see what is optimal for that, and you would go for that. So this picture lets you, work with different sigmas and see what it is, and you can choose depending on that. Okay. And everything can be computed, so that is okay. As long as you know the basic characteristics of ABC, you can do this. And the same picture holds if you had 1,000 assets. You get exactly the same look. This hyperbola and all combinations existing inside it.
Okay, thank you, sir.
Okay.
No other question. Yeah.
Okay.
So Shajidjo, please take.
That was an amazing lecture, Professor. I'd like to thank Professor Habib and all the attendees. I would now like to call Professor Gaurav Tripathi from the Department of Mathematics to deliver the vote of thanks. Over to you, Professor.
Thank you, Shajidjo. Am I audible?
Yes, sir.
So I'm delighted to get this wonderful opportunity to deliver the vote of thanks. I'd firstly like to thank Father Principal for his benevolent presence. He had always been supporting us for these e-colloquium sessions, and this time also there is no exception, and he still attended this time too. I'd like to add that when we first started the colloquium, it was not an e-colloquium, and just after we had one or two couple of sessions, immediately the pandemic started, and we all felt bad that we cannot continue this further. But then our HOD took the entire responsibility of initiating this e-colloquium, and that we are running this colloquium successfully rests much of on her shoulders. So we are all thankful for her contribution to the department. And e-colloquium you cannot have without the help of the technical team of the computer science and the support staffs. So I thank all of them and all the students who had been in the organizing committee, that the teachers didn't have to think anything of the technical things. They have designed the posters, created links, groups, in spite of attending all the classes in online or offline mode, both ways. So I thank all the students and also to all the professors who have attended the talk. A special mention to Professor Diptiman Saha, who has done all sorts of, he's involved himself in all sorts of activities regarding this colloquium so that we can run this successfully. And lastly, I would like to thank, lastly but not the least, Professor Habib, the mathematician of such a high stature and yet has accepted our invitation amongst his busy schedule. So we are all thankful to you, sir. And hopefully we will get some more insights from you in near future. Okay. So I now hand it over to our HOD.
Yeah, thank you, Gaurav. And thank you, Professor Habib, for delivering such an intriguing talk. Thank you so much.
Yeah. Thank you, everyone.